Thanks for the introduction. We've got a lot of brains up here on the panel tonight, of moderator excluded. Technology. We're seeing unprecedented levels of change in this sector, and it's now spilling out of the sector, I think, and into a number of areas of the share market and companies that trade on the share market. And the next 10 years, I think, is only going to see these trends accelerate. There's fortunes being made overnight for some shareholders and businesses. I think there's also a lot of fear in boardrooms around the country about what the future holds. And hopefully to flesh out those ideas and pick the brains of some of the best tech investors in the country, we'll go through all of that if we've time. Daniel, we'll come to you. We've already heard the word disruption. It's now being seen as too often used, but to me it actually looks like it's accelerating. And the irony that I see is that the bigger and safer and more blue chip a company is, the greater the threat that disruption faces. Is that right? And also, on the ASX, where do you see the threat at its greatest?
Look, I think long view, short view. The long view is that every single company in every single industry is going to go through massive disruption. Massive disruption. If you take that Oxford paper that was written a couple of years ago, January 14, and they looked at 52% of all jobs in America will be disrupted or destroyed by technology. You look at the impact of machine learning, artificial intelligence, advanced robotics. I mean, there's just no question that there's massive disruption coming to every single company. In the short term, it's more about sort of marketplace changes and intervention in the stack between the product and the consumer that starts to change the offering. So I think Australia is a country which is particularly lazy in its large corporate sector. You haven't had to be that innovative to survive in any of our oligopolies, and most of our major industries are oligopolies of some form, either structured formally or informally so. And our sense has been that sectors like healthcare, like the finance sector in particular, and education are three protected sectors that will be disrupted dramatically going forward because they've been let alone because the global technologies which have hit media and hit retail haven't really hit finance, education and health because it's regulatory and other issues. Yeah. But there's no question that going forward those three sectors are under immense pressure. And I will say, to take from the discussion earlier, that I think the boards of most of those companies are behaving appallingly. I think they've got no idea what's going on. I think they're just worrying about the next board position as opposed to thinking deeply about the underlying strategy of their company and what will happen going forward.
Okay. Alex, you're not nodding off there. You purely oh, it's a good answer. Yeah. You purely invest in disruptive businesses. Give us an area of the market, narrow down an area of the market to us that you see is under threat. We've got a lot of retail shareholders out there. What should they be wary of in their portfolios?
I want to add to the finance one that Daniel and Elaine have been talking about. Yeah. Of course, the big one is going to be transportation, oil, and cars. Yeah. And that's an elephant, right? Because we know that we can see all this coming to fruition right now. Aramco, which is the Saudi private oil company, is talking about listing its assets for between $1 and $3 trillion. You've seen the PEs of General Motors, Daimler, VW, Ford, all contract into single digits. GM's on 5, Daimler's on 8. So you can see that these companies, which are in the old kind of petrol-driven, engine, when that's about to get basically swept away entirely. Because one of the things that the electric car does, and we talk about this a lot, is it removes crankshafts, it removes oil filters, it removes gearboxes, it removes exhaust systems, it removes catalytic crackers. All those things come out of cars, and if you think of the value chain that's associated with that, then if you take the multi-trillion-dollar stuff that's happening in the oil companies and then add it to the probably sub-trillion-dollar of value in the car companies, you get some very, very major levels of disruption. The car companies in the United States are already coming down into these single-digit multiples, and we can see that happening already. So to pick up on your point about the risk of not investing in disruption, if you're just sitting there as a shareholder in Exxon or General Motors thinking, oh, that's okay, these car companies and oil companies are going to be right for the next couple of years, well, they're already starting to derate. And what we've seen is that once the derating process starts, it continues. We can see the perfect storm coming towards us with respect to oil. And self-driving cars is another layer on top of that as well, because when you get the self-driving car, then the whole idea of needing to own a car falls apart as well, because you call up a car, it arrives to where you are, you get out of the car moves along to somebody else. It's not a taxi. A taxi is way more expensive because a taxi includes the cost of a driver. Once you take the cost of the driver out, you cut the cost of the car in half. And in doing that, you make the car not just a little bit cheaper as a taxi, you make it dramatically cheaper. And that changes the whole paradigm. So to answer a couple of those questions, and then to circle back on the question about boards, the story with respect to what's going on, and I've seen it for years in this country with respect to the boards of media companies and others besides, is if you seriously ask board directors, you know, do they know that this storm that Daniel talks about is coming, they will privately say, of course they do, and of course they do. They are not stupid people. But they are driven by incumbency, meaning that their numbers and their executive teams and their remuneration structures are all driven ultimately off the share price. And in order to keep their management team paid, so to speak, what they need to do is keep the share price high and keep investor confidence high. That is why it's not that the directors don't know, they absolutely know. They are stuck in this thing, which is we must continue to talk the story as it is. Multiples derate. You and the investor see it as an absence of growth initially and then negative growth. Meanwhile, companies that you think are on high PEs, as it were, kind of keep getting higher as the disruption takes place. I'm sorry for that long answer.
That's good.
On that, I mean, it's an interesting point. You can even look at some of the tech companies, and you say, take REA as one example, and Domain, which is a proxy for everything that's valuable in Fairfax. It's a proxy, you know, for public listed domain, and you know, we all know that in the tech sector that the idea of paying to list in classifieds is stupid. You know, why should I pay $6,000 to list a bunch of bytes on a server where it's costing that service provider a cent or near zero? It's just mental. And so around the world, paid listings online is going away. It's all paid for performance, which is the listings go up for free. And then if someone clicks on that listing, whether it's a job or a car or a house, then someone gets paid. But here you have REA as one example, or Seek in the jobs, and I think Seek's doing a much better job of moving their model. REA is built on paid for listings, yet the REA would know that that model is going away. Yet they're also stuck because they're trading on a 37 PE, and they would know that really what Rightmove's doing and Zoopla's doing in the UK, which is paid performance, is in fact the new model. Yet they're also kind of stuck and trying to pretend the world's not changing. So this sort of phenomenon of trying to pretend the world's not changing occurs in both traditional companies and also, in fact, in new companies. Yeah. Now, in the case of Seek, they know that paying for job listings is mental, and so they've now moved into geographic areas where paid for job listings is okay, and then moving down the vertical stack into ATSs and other things, so application tracking systems, which is another part of the job stack. So they're diversifying their revenue streams, but it's not just the traditional companies that are struggling.
And Elaine, you invest in a lot of alternative assets. Is there an area in that portfolio that you're seeing these forces at work?
Oh, look, we see this in all industry sectors, but one that is near and dear to our heart at Blue Sky is agriculture. That's another sector where I think, you know, a wave is coming of disruption. It's had almost, you know, there's been a lot of innovation around the edges, but not a lot of innovation being implemented in some of our larger agricultural companies. And there's a real kind of investor divide on how they view agriculture. It's still viewed, our primary industries, as this incredibly high risk sector to play in, and oh my God, I can't think of actually an area where we have so much alignment around the research and development expertise, the industry expertise that we have in the market, and are standing on a global scale. You would think this would be a natural area that we would plug a whole bunch more investment into, but we sadly don't.
And okay, we don't want to be too pessimistic like the three previous panels before us. there's got to be opportunities in this space. Do you have to go offshore as a retail investor to harness it? Because one thing I always wonder is, like, you know, most people out there can't go and stick money into a startup company. They can't diversify enough. So how do they access this sector and try and get the benefits of it rather than worrying about the negatives?
Look, to quote a Turnbullism, the melancholy truth of this is that the difference between the S&P 500 and the ASX 200 over the last 5 years, and one's outperformed the other by 7 or 8 or 9% or whatever the figure is, the melancholy truth is that most of that outperformance has come from, you call them the tech sector, I call them disruptors, the Amazons and the Googles and the Apples, even the Microsofts, etc., etc. The melancholy truth is we don't have global scale disruptive technology companies in Australia. And so it would be a fantastic thing if I was able to say, you know, we don't own Seek. It's not that we don't think it's, you know, they're great people and all the rest of it. It's just that, exactly as, you know, the point about the exercise is the global technology majors are taking a greater and greater share of an increasing number of businesses. The Baidu, Alibaba, Tencent troika in China, which are companies that we invest in, are not just doing games. They're not just doing, you know, retail door to door. They're also moving into the self-driving car. Because, and it sounds kind of crazy until, again, you think about it. The head of Baidu says the advantages with, or the competitive advantage in the car industry in the last 100 years has all lived with the Japanese and the West. Going forward, the competitive advantage in the car is going to be software, because really there's not much in the car other than some wheels. You need those, and the software itself, and a technology system to get the energy in. And as a consequence of that, the expertise moves out of the West and the Japanese into China, and it will stay. And this is why Apple, by the way, and Google are spending so much time on it, because they see that this is where they need to be. So to answer your question, kind of long form, if we had companies like that in Australia, I would jump at them, because I would prefer to be investing here. But frankly, the big are getting bigger. They are and moving into more and more industries, and it's increasingly difficult to dislodge them. I'll finish just with one quick point. Pandora, interesting company, music sharing company, etc., absolutely being smashed by the Apples and the Googles and the Amazons, because they can cross-subsidise their business across many platforms. Pandora is a single product company, which is music sharing. Where are they in the ecosystem?
Yeah.
Sorry. But we do have those companies in Australia. Perhaps they're not sitting on the ASX, but we do have those companies. And like, to your point about how do retail investors access them, I think, you know, this is probably the wrong forum to make this statement, but we are too obsessed with the listed market. Like, all the growth is in the private market. If you look at, I mean, Jared Menak had a slide, The Economist, on how the, you know, Australian listed market has performed versus the Australian private market. And the private market outperformed the listed market by about threefold since 2009. And it seems difficult that retail investors can access the private market, but it's not impossible. There are certainly way more platforms and mechanisms for, you know, mums and dads and self-managed super funds and to access technology companies and high growth companies in the private market in Australia.
I don't mean to disrespect that, and I'm not disrespecting, and please don't think that I am. It's just that where the rubber meets the road, for a lot of people, they need access to liquidity, and that is, it's not that you can't make fantastic money in startups, you can, but if you need liquidity, that changes the equation.
There's a trade-off for liquidity, which is, you know, lower performance, for sure.
Daniel, I think Alex makes a valid point that in certain sectors, the global players will dominate, and I think, you know, you'd be a crazy guy to fund a search engine now in Australia. That'd be kind of weird. Or, hey, I've got an idea for a social network, really? So I think, you know, they're obvious, but I think I think in health, finance and education, there are opportunities for local players. Now, you know, you're not going to create a Google overnight here, but you will create companies that are worth a few $100 million in each of those sectors, if not maybe $1 billion. So I think there will be opportunities for retail investors to invest in Australian companies in those sectors that will be good, and they'll be fundamentally software plays. There may be some biotech plays as well. So I think that I'm actually quite confident that they will come to fruition. I think I happen to own Seek. I think Seek's a 16 PE. I think it's a good a good buy, although I'm mainly in the unlisted space. That's where I spend all my time. I'm not a very good publicly listed guy, but I do like that. I think that there are other ways retail investors can play. I think the whole idea of crowdsourcing and things like Angel List are not just 32 red at Star Casino. I think there are ways you can track very good investors who've historically shown very good investor performance, and you can invest in companies there. And some of those have secondary markets for liquidity too, so they're not completely closed up for the 10 years. So I think there's that aspect as well. And I think there are ways for you to participate in the global tech companies as well through fund managers that have liquidity. I think that the biggest issue that I have, and I think we've written about this a lot at Airtree, is the crazy listing of crap companies in the ASX in the technology space.
Okay, I wanted to ask about this because I think this has actually been streamed on the ASX, so we don't want to
Sorry,
bring down the message.
when I said
I don't want to
really good.
Yeah.
That's right.
But the ASX is proposing on changing some of the rules. I totally agree with you. I think the struggle I see is that we've got a very small handful of very high quality tech companies, not much to choose from, and fairly mature in their market stage.
Yes.
And then there's a whole raft of concept stocks that aren't making any money, are comparing themselves to Instagram or Facebook and saying we're going to be the next thing. Mums and dads are reading it, they're falling in love with it, and the thing goes broke and they get put off investing in technology. So are the changes they're proposing good, or what should they be doing to promote technology investing?
Look, I think that there are arguments that we should be relaxing the listing rules for tech companies. And when we say tech companies, I think when we look at businesses that happen to use technology to help them. I don't look at crazy, weird technology stuff. I think it has to be a business that is underpinned by a platform or technology that makes it a better provider of a service to a customer set, be it enterprise or consumers. So I think the problem we've seen to date has been that exactly this point, that there's been a fairly thin market for high quality technology businesses. Some of them are maturing and their growth rates are coming off. People are seeing what's going on in the US in particular, although in China as well, but in particular the US, and seeing the opportunities. And then you have some firms promoting these backdoor listed mining stocks or new listings on the promise of this great world, and it's just not happening. And yet mums and dads get pushed into them by overexcited analysts and brokers. I think that's terrible.
Receiving 5% fees to
It's
place
terrible.
That money.
And a lot of these companies are companies that have come to the professional investment sector, the Blue Skies and the Airtrees and others, and we've said, you've got to be joking. And next thing they're listed on the ASX. Some of them are okay companies, but the valuation is nuts, and some of them, both things are nuts. It's a nutty idea, it's a nutty valuation, and it gets away, and that really upsets me. The reason it upsets me is because when those things go pear-shaped, and you look at One Page today, One Page is 90% off. It's 1 year high, 90% off, and Refined is 93% off its 1 year high. Now maybe it's a fabulous buy, right? And it's going to, but chances are maybe it's not. And I think the problem is that the mums and dads who buy into these companies think, this whole thing's rubbish and this technology thing's rubbish, and in fact it's not. The underlying role of technology in changing business models will continue to accelerate. Yeah. So I think you've got to parse out the quality, maybe thin quality retail stocks you can easily buy, find a way to access some overseas quality stocks, because there are very good overseas quality technology stocks, find a way to participate in a slightly less liquid way through perhaps some quality crowdsourcing platforms, and then through funds, whether it's technology funds or whether it's private equity funds.
Yeah.
I think there's two problems with what we've seen with some of these lower quality tech companies listing on the ASX. One is that investors are not protected because there's no one filtering these or providing any sort of guidance to investors about what the quality of this is. And everyone says, there's a prospectus and there's, lots of information's public, but there's still massive information asymmetry in that transaction, which is not being mediated or filtered by anyone. So part of these changes are to protect investors from exactly what Daniel just outlined, which, generally just is better for the industry and the credibility of the industry, full stop. The second is that companies that list earlier than they should, because of our investors looking for liquidity, when they don't perform as planned, which almost always happens to early stage companies, even the ones that, all of the ones that we would invest in.
There's a reason they stay private for a while.
That immediately people sell down, and that is the most immediate way to decimate the value in your company. And and kill any future and opportunity that you had. So these changes are twofold. They're to protect our investors, but they're also to protect the companies as well from not doing something completely stupid.
Yeah.
And they are doing this as a mechanism of last resort.
Yeah.
They're not listing because they want to list, because who would want to do that?
They need equity capital, and that's the only way that they found that they can raise it.
Yeah.
So, Alex, when is the time to list? Like, should you be generating revenue? Should you be profitable? Should you have a certain number of subscribers, which sort of says that the business is happening? What, you got a view on that?
I'm not. I guess you're asking me this question because I listed a couple. It was a long time ago, and
Still, they've done well.
They have done well. Look, frankly, the companies that I listed were Seek and Car Sales. It was easy to see. You know, we had 3 or 4 year financials. We had cash flow statements. We knew what the funding rounds had been along the way. We knew what the cash burn was. We knew what the revenue was growing by. We had a high quality group of directors. We had stable funding partners. We really actually had a very clear insight into the way the business worked. And I can't remember, I think Seek and Car Sales both listed on 20 plus EBIT multiples.
Right.
I'm pretty sure that's right. I mean, they grow into the EBIT multiples, and Seek has quintupled since then, plus a bit, and Car Sales has done well as well. I mean, the answer to the question is when you can see and really, you know, have a lot of comfort with respect to what the trajectory is going to be in terms of earnings and cash flows, et cetera, one, and then two, you have to have a reasonable amount of understanding of what the underlying business model is.
Yep.
And so in the case of Fairfax, Car Sales and Seek, it was all about what Fairfax was not doing. It was all about the directors talking the incumbency story, seeing the absence of growth in their figures, seeing the presence of growth in the online figures. So you had a kind of black and white, as it were, thing that you could look at, and therefore it was easy to see how the story would unfold. So, you know, those things should really present themselves, in my view.
You can, I mean, I think you probably don't want to invest in companies that have got no revenue and just got users. I think that was sort of that was the 1999 party. I think that party ended pretty badly for most. So
that party seems to be coming back.
No, I think the idea of investing in users as opposed to anytime monetization is pretty crazy.
Yeah.
But there are times where companies will need to list ahead of large revenue because if it's a biotech or if it's, there are reasons you would. Yeah. And so what we look for the underlying business models. This is one of the private you can apply to the public space. We also actually look really hard at the unit economics to understand, for one customer to buy a product, is that a positive unit economics? And so all you need to now believe is you can get growth to cover the fixed costs of the underlying business because unit economics are positive and our churn rates and cohort analysis looking okay. So if you can apply those sort of analysis, okay, well, the cohort analysis looks good, it doesn't drop off too fast, the churn is very low, unit economics are positive, so then you might be tempted to pay a reasonably high price on what is a low revenue stream because you can see those things growing out.
And the only other thing I would add to that is that you need to have a lot of confidence that the management team can then execute on precisely that plan.
Yeah. So I'm not sure if we're getting the wind up there, Jimmy. I think all the other panels went over, so we probably can a little bit as well. You all sit in front of a lot of technology companies. What are 2 or 3 things that you've got in common that you look for before deciding to invest? Or is there something that is a warning sign that will put you off?
I look for platforms. Right. In the first instance, because where there is a serious enough network or a platform, then the ability, because of what the technology is doing, the ability to then use that platform to disrupt other kinds of businesses is significant. I mentioned before the Pandora, Apple Music, Amazon Music, etc. before. So I wouldn't invest in Pandora because it's not a sufficiently large network, but I would invest in Apple and I do invest in Google. We bought Amazon 2 years ago. It's doubled, so that's good. So it's good. So where there's a large enough platform to begin with, and there are sufficient adjacencies in the platform where they can grow into different business lines. For example, the car is one that Google's growing into and Apple's growing into, and the Chinese companies are as well. Those things are attractive. And then we look at cash flows and multiples. We're not obsessed about buying multiples of 5 or 10 or 15. We don't. Things are expensive out there in disruption land for very, very good reasons. I mean, the difference between 2000 and now, when we valued companies on user growth, is almost all of these companies, and I mean every single one, are sitting on massive cash piles because they haven't, they're not geared, they're not burning cash, as it were, to get themselves funded. They are sitting on massive cash piles.
And they're not paying dividends either.
And they're not paying, well, they could.
By and large,
But so they are very well-funded businesses with adjacencies, with great networks, and that's kind of what I'm looking for now.
Guys?
We look for 5 attributes in companies. So in our first 15 months of the new fund, we literally saw 1,150 companies. We did deep dive, sort of medium dive with 430, 130 deep dives, 25 term sheets, 13 investments. So we look for 5 attributes. We look for outstanding talent, it's outstanding management. We try to codify what that actually means.
Yep.
We look for very, very strong product market fit. Do people care about the product enough? Do enough people care about the product enough? Because sometimes a couple do, not many do. We look for very strong monetization, this unit economics thing, and stickiness and cohort analysis and churn. We look for very strong differentiation. Why will this company succeed in the global sphere of all these companies attacking that? And it can't be just because they're going to try harder. It's got to be something fundamental about their offering, their platform, their technology, their market access, their distribution. And then we try and understand what the cash burn profile will look like, because we don't like businesses that plan to burn cash for 4 years. That's a bit scary. Well, we understand you're going to have this curve, but it's got to be, if your unit economics are right, this curve will do this. If it's going to do this forever, it's not much fun. So.
Elaine?
Exactly the same. We have a very similar focus, and therefore we have the same sorts of things that we look for. The only thing I would add to your original question about what are things that are red flags for us, the things that we won't invest in. Anything that's outside of what Daniel just articulated are certainly no-goes for us. But the things that we also want to make sure that are part of the investment thesis is that the management team or the founders or the people who are very critical to the execution of that business over time are incentivised in the same way that we are. So we are hugely turned off by huge salaries. We are hugely turned off by people not having strong equity in the business and therefore really incentivised and aligned with us to grow the business and its value. So we often do see scenarios where those two things are a bit out of whack. And even if we love the business and we think the unit economics are great and the growth story makes a lot of sense, we won't invest for that reason. And the other is that we need to see real evidence of grit and hustle, because where we have been caught previously is where they've done a very good job of getting a business from where they started to where it is now, but it's actually been a pretty easy ride. And there's no real validation or understanding that they really got the grit and hustle to do stuff, to do the right thing when things turn a little bit pear-shaped. So we try and, screen for that too, although it's more vague and difficult to codify.
Daniel?
One question which if we ask this question, if they give the wrong answer, we literally run from the room screaming. Is if we ask the question of, who are your competitors? And if they say nobody, we run.
Everyone's got a competitor.
Absolutely. But you'd be surprised how many people who come and say, that nobody in the planet's doing anything in this space. Really?
I think there might be. All right. Are we up to the Q&A session now, James? Yep. I think he's giving me a nod. So anyone want to put their hands up and maybe ask about some existing companies and what they think the industry is looking like? Okay, we've got one down here.
You touched on EVs and autonomous vehicles. This is a question for you, Alex. EVs in autonomous vehicles, just interested to explore a little bit the implications of how that can affect, what the market implications are for those developments. I mean, I understand what an autonomous vehicle is, but what are the flow-on effects of that? How does that change society?
Well, it changes first of all, it changes car ownership. You mean society or business? Sorry, okay, society. it changes car ownership structures massively. So that, you know, the entire transport industry, the car leasing, you know, model is going to change. The car ownership model is going to change. The taxi industry is going to change. I mean, the transport industry in the US is a documented employer of close to 10% of the workforce. I guess there's be a lot of people on top of that etc. So that will have massive flow on. And then the next thing that happens is, if you, for example, don't really need to park your car because you just call it up because, you know, there's always one going past because that's the way they work, then that has implications, for example, for retail property trusts. Because if you don't need to build parking into your retail, into your site, that has massive implications. It also has massive implications for the way companies build car parks for, you know, city buildings, etc., etc. That whole. So we're currently doing the oil companies. So that's that big, you know, couple of $1 trillion worth of value. The car companies who make it, all the auxiliary car companies that do the parts, the taxi drivers that drive them, all those industries get changed. The people who operate in that, you know, massive industry, which is the parking industry. You know, I mean, it does kind of go on.
Motorways, I mean,
Pardon me?
Motorways, I mean, the estimates are that autonomous driving vehicles will reduce cars in
100%.
by anywhere between 10% reduction to 50% reduction. Well, you wouldn't want to be long in motorways in 40 years' time.
I mean, the average person uses his car 5% of the time. Now, that doesn't mean that you get a 95% reduction of cars, because peak cars will be determined by peak demand.
Yes. Yeah.
So that's what will... But there certainly will be the capacity to reduce the number of cars on the road by 30 or 40 to 50%. And this argument about, you know, oh, well, I want to drive a particular kind of car, you know, you can already, as it were, tier your demand for a particular kind of car so that you get a, you know, an Uber X or a, you know, a platinum car, or etc. So plenty of implications.
Alex, when do you reckon this is going to happen? Like, when will I be able to get into a driverless car in Sydney?
Well, Martin Dalgleish, with whom I had coffee yesterday, said his children said to him as he was bringing them into the city yesterday, "Dad, could you put your hands on the wheel? Because it's making me nervous." So the answer is now.
Well, Tesla now has...
He's in a Tesla now.
The Tesla, I just drove up the coast weekend before last, and I didn't touch the steering wheel.
Yeah, but there still is someone behind the steering wheel. When do you think
Sure.
they go
That's a
fully
regulatory
autonomous?
issue.
Yeah, it's a regulatory issue. I mean, the technology is basically there now. In fact,
Yeah.
on Teslas now, you can get out and it can park itself in your garage, and you summons it from the garage.
Yeah.
And there's no difference between, you could summons it from 400 metres away as well. But the regulations don't let you.
4,000 miles.
Yeah, exactly.
Okay. We got any more questions? Or James? Yep.
Just interested in your thoughts on Telstra, which especially given your comments on incumbents, and also just in terms of Australian companies that can kind of make that global leap. Just a couple in Australia and New Zealand, Xero and Acunex.
Well, I think Telstra and Google are both trading on the same PE at the moment. I looked that up before I came on stage to try and sound intelligent on public listed stocks. And who do you think you'd bet on better growth potential, or who's got more downside risk? So I think you know, you'd have to argue potentially.
Telstra's on double Apple, I think.
Yeah, Apple's I think 11. Yeah.
Well, there was that famous quote from Solio Trujillo when they were selling Census, and an analyst said, "What about Google?" And he said, "Google schmoogle."
Yeah.
Which turned out to be probably one of the worst decisions in Telstra's history.
I think you look at the Xero case though. I mean, Xero is a fantastic company and doing super well in terms of its adoption rate, but it's at a high valuation. You know, Excel, which is a really well-known, really successful, smart venture firm in the States, they put in $100 million at I think $25, and it's trading at 16, I think. So there's a difference now between, is it a great company? Absolutely. Is it a fair value? I don't know. So you've got to be careful.
Yeah.
Yep.
Hi. Question to Alex. Sorry, I'm here. Best way of playing autonomous motor vehicles and electric cars? Obviously, it seems Tesla's already got the technology in place, but you've got Google spending huge amounts, Apple, as you've mentioned. So as an investor, do you sort of play all three, or do you have a preferred option, or is Tesla potentially a takeover target because of all their technology by maybe a Google who's working on the software platforms? I don't know, I'm not...
No. Your question is well put. It's accurate. Tesla probably is a takeover target because what they need to do is significant. Disclosure, we own some. We own Google because of the self-driving. We own Apple because they are spending billions, and actually Morgan Stanley reckons they're spending a lot more than all the companies put together on the capex for the car. I haven't heard anything about what Amazon's doing, but the ones to really watch in this space, in my view, are Baidu in particular, who are very far down the neural networks AI track, and so are talking about the release of an autonomous vehicle in 2019. And if they do what they've done in the past, and I've been watching them for some time, they will deliver on that, I have no doubt. So those, and obviously you can also play it through the NVIDIAs for the graphics processor unit, and there are a bunch of others as well. There's some quite interesting ways to play it, but you can certainly get some, and then you can as well. Apple's just bought into a company that's doing the Uber rival in China called Didi. Spent $1 billion on that. You've got to believe that that's going somewhere. So there's a range of different options and a range of different ways to play it, and they're all quite interesting.
I think it was super interesting that Warren Buffett bought $1 billion worth of Apple stock, and there's a guy who's really avoided technology forever.
Yeah.
And he's been a value investor forever, and he's now bought into Apple.
Yeah. Although they reckon it could have been one of his lieutenants who's got a bit more autonomy, but certainly seems to be slowly embracing the change that's happening. James, have we got any? Yep, just over there.
Hi, this question's for you, Elaine. I'm just wondering what sort of disruptions are you seeing in the agricultural space, specifically within Australia, in terms of technology? Where's that going?
Yeah, I mean, we see a whole raft of different technologies in ag, from ag tech, which is focused on precision farming, to more efficient ways of using water, to different field varieties that have various different characteristics which are more beneficial, need lower inputs, have higher yields, a whole bunch of different things. But then we've also seen, that's on the tech side, or what I would sort of say is really sort of early stage tech-focused agricultural investment. But we also see a whole bunch of things that run up that value chain, which are also not finding a home for investment. So whether that's change of use type investment strategies where you've got farmers who've got a lot of know-how and input, they want to change the crops that they're growing to crops that have a greater yield for the water input that they have, production and manufacturing, processing opportunities which just cannot find investment but are, high revenue generating, highly profitable businesses. We see everything along that entire spectrum, all the way through to big farm gate type opportunities as well. So we're seeing everything and anything, and there's currently just not many investors who are open to investing in that space, except for foreign investors who would love to invest in that space, from in the very early stage all the way through to the more advanced opportunities.
We look at the same space. I don't know, Elaine, but I'd say that there's not as much innovation going on there as you'd expect, given how dominant or strong the sector is internationally, agriculture for Australia. There isn't as much going on, which is a bit disappointing. There aren't as many founders and cool new things going on as you'd expect.
And I think part of that is because a lot of the innovation's actually been done at the farm level by the landowners and the farmers, rather than it being in ACT-focused research institutes and sort of bearing out of that. And a lot of those founders or innovators are, highly leveraged. They don't have a lot of cash to kind of help them develop some of these new innovations and take them to market. They might be instituting it on their own farm, but to kind of take that more broadly is actually really difficult.
I mean, I think that is absolutely right. If you look at where Australia has a serious competitive advantage, it is, for example, in mining. We are really, really good at it because we've got so much of it. We're really, really good at farming too, and yet we are not the packagers up of agricultural land for use for the benefit of investors, and it is crazy.
And
I think it's crazy.
One of the criticisms that's made about Australia and innovation and our lack of performance in it is that one of the rate limiting things has been our lack of industry. You know, we don't have, I mean, we do have an office of Google here, but we don't have an equivalent of that industry sitting around us ready to be recipients or receptacles of the innovation that we develop, and we don't have that exchange of talent between a near industry like there is in, say, Israel or there is in you know, California. But if there is one industry that we have here that is near and dear and able to do that exchange of talent and bring that expertise to bear, it's primary industries in agriculture.
We have global scale in that.
Correct.
Okay, I think that's it. Thanks to the panel. Have a good night.